Charlie Munger has often said that the easiest way to succeed is to avoid doing stupid things rather than chasing brilliance. And so I'm basing that quote off of an article of a guy who wrote of his 19 core principles. So we're going to run through all of them and talk about them, see if we agree or disagree with them.
All right.
On the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people with core principles so that together we can build wealth while improving housing. I think I got all of it. I'm James, and this is my wife, Jessie.
Hey, another friend has a quote about stupidity. What is it?
Stupid should hurt.
No, it's something like, if you're gonna be stupid, you got to be tough.
Oh.
Something to that effect, where it's like, sure, yeah, go for it, but you got to deal with the consequences.
That's okay. Okay. I could get behind that particular quote. Yeah, this one that we're going to talk about today is an article is from a student of the real estate game, is what he calls himself. I have a hair somewhere in my line of sight. I'm just going to ignore it. But yeah, in this article, he talked about his 19 core principles for investing. And I thought it'd be fun to run through them and talk about them.
Student of real estate.
Yeah.
I guess that's what you could call yourself too.
I suppose. Yeah. So number one is about deal fundamentals.
Mm-hmm.
You want to find motivated sellers. So every good deal starts with a motivated seller.
Makes sense.
Yeah, I agree. I definitely myself have been an unmotivated seller, and I'm like, yeah, I want top dollar. Otherwise, I'm not going to sell.
Right.
And I think it's because it allows you other avenues to work. There's other priorities other than price, I guess.
If someone is motivated.
Correct. Mm-hmm. Yes. Correct. Number two is you want to have an investment thesis. Okay, I know, right?
Like a
Big
reason
words.
for investing.
Yeah, it should be comprised of 2 to 3 levers which drive all your value, and everything else is just noise. And so, like, oftentimes what we talk about for my investment, it's essentially like, here's what I'm looking for. Here's my thing. Here's what I believe to be true about this investment. Like, for example, for me, part of our investment thesis, I will say, I'll look at pretty much any deal as long as it's a good deal. And what I'm talking about is usually it's value add and it is at some sort of discount for some reason.
Yeah.
So I want the combination of two, which is genuinely tricky. I'm less concerned about the market. I'm less concerned about the asset type. Those are less part of my investment thesis. But I've talked to other people where they're like, no, I'm only buying in this area.
Oh, interesting.
And that's it.
So it's all based on location or...
Well, not all, but yeah, that's part of their thesis.
It's more important.
They're like, I want to be able to drive by every single property and be there in 20 minutes.
Sure.
Because they're going to manage it themselves or something like that, which is totally fine. Makes sense. Number 3, I like this. You want to have simple underwriting. And we've often talked about this. And so I agree with this statement of, you shouldn't have to make it complicated to see that it's a good deal. Yeah. Because if you've got to like have 15 different knobs and really tweak the lines to kind of make it work, and then and as a result of that, it passes.
Yeah.
Is it a good deal?
Yeah. I remember at some point we had this conversation about how you were like, I want it to be a good deal, like without adding in all the like potential extra of like, there's an upside here, there's a potential upside here. It's like, no, let's look at it at the bare bones. And then anything on top of that is just, it's like icing. It's extra.
Right.
You know, if you evaluate it super conservatively and then it turns out better, that's better than
amazing.
Like tweaking everything, making it look super good and being like, I think this will work. And
I've often found like, if you just quickly whip up a spreadsheet and be like income, vacancy, operating expenses, and like you go, let's do your NOI, subtract out whatever your debt payment is. Like if that number's not positive, like it's not 100% true, but it's kind of like there's not much you're going to be able to do from an underwriting standpoint to get that number to be positive. That's now. You may still buy it because there's other reasons where it is a value add, and you go, in year one, it's not going to make any sense. But
it's not positive now, but it will be.
Yeah. That's been my like, you can mess with some of the things, but like keep it simple. Also related to that, He says to only buy deals that have a clear, supportable path of net operating income growth, which I think you fully get beside or get behind.
Oh yeah, yeah, my rule of thumb is way more. I don't know if you call it conservative or like I want us to make money day one.
Well, so that's different. So yes, but are you okay if it makes the same amount of money every single day for the next 10 years?
Oh,
He wants clear path to net operating. He wants it to grow.
he wants it to grow somehow.
Yeah, however that works. Which
That's interesting.
Yeah. I can get behind.
Yeah, I guess I haven't really set that as an expectation, and I'm like, as long as it's not losing money, I'm okay.
Right. Now, in theory, again, if it's flat, you're getting less every single year because of inflation and stuff like that. But that's one of his things. And then I also like this one. He says, "Don't buy the value created, create value." Which again, that's part of my investment thesis. I'm like, yeah, I want to be the one to go in and create the value, not get one that's fully fixed up. I want to sell those.
Yeah.
And there's definitely people out there who are like, man, I just want the cash flow, consistent cash flow, low maintenance, low worry, like it's turnkey, ready to rock because I'm busy doing other stuff.
Yep.
Like, yeah, 100%. I get that. That's not me. That's not this guy either. And I'm okay with that. Okay. Then he switches to talking about market dynamics. Okay. So buy below replacement cost, I thought was interesting. So replacement cost is if the building burned down, here's how much it would cost to rebuild it. And so he wants to buy for less than that is one of his rules.
Okay.
Yeah, which I've never really thought about, to be honest.
Yeah. Why? It seems like that value would be more than like the market value or what someone would be willing to pay for it. Oftentimes, maybe.
Yeah. I've talked to other investors about that actually, where they've been like, oh yeah, like that, like when we were talking about the buying a Baker Tower, I remember talking to an investor about that, and he was doing the math on it, where he was like, holy cow, man, if you were to rebuild this thing, it's like $10 million. Because you can buy it for 1.8, at the time 1.6. He's like, that's a great deal. And it's like, oh, I mean, at the end of the day, cash flow is what matters.
Yeah.
But that's just one of his check boxes is what would it cost to replace this? If it's less, okay, that's good news. That means you're not going to run into problems if the worst happens and you do have to rebuild.
Yeah.
I think it's more of a safety net rather than like a strategy.
Like a strategy for making money. Yeah.
Yeah. Also, he talks about supply and demand. Market fundamentals ultimately drive all real estate values. Focus on areas where demand exceeds supply for sustainable appreciation.
So that totally makes sense.
Makes sense.
That's that's kind of like, why would you buy somewhere where there's nobody wanting to live there?
I was reading this article recently. It was talking about population trends, and he was like, there have been more deaths than births in this area, and he goes, but like the population has been going up. He's like, it's purely from migration. And which he was like, why in the world do people want to move here? He's like, because prices are sky high. Because it was talking about a real estate thing. He's like, prices are sky high. Why are people moving here? I'm like, well, it's for other reasons, man. Like the great weather, the jobs, whatever.
You're talking specifically about Oregon?
Yeah, Corvallis, Albany.
Oh, wow.
Well, no, it was Benton and Lynn County. Yeah.
Okay. Interesting.
Yeah. The net.
People would move here for the weather?
Well, so what was his?
Wet.
He was talking about for. Dude, I
mean, there's not natural disasters.
The math for Lynn County, because they published this stuff, was like we lost like 400 people. 400 more people died than were born, but our net increase was like 1,100.
Whoa!
And so it actually meant like 1,500 people moved here.
Sure.
Yeah, which if you think about it, just like those are people. So if you assume 2.5 people per, that's a lot of new units that you need to come online to handle. I mean, because they seem like small numbers, but you're like, dang, dude. If you're not building somewhere between like 500 to 1,000 more units, like you're getting behind, which is the whole supply and demand thing.
Yeah.
And so like, cool. Good for this area, I suppose. Okay, now he then switches to talking about capital structure strategy. And I thought this was interesting. He says you want to conserve leverage, which makes sense. You don't want to over lever a deal, essentially take on too much debt, and you want to use fixed rate debt whenever possible, which I agree. And that's all smart. It's leverage is an interesting two-parted sword because on one hand, it really can goose your returns. If things go great, leverage is amazing. But if things go bad, like they go bad really fast.
Yeah.
Because it's a lever.
Yeah.
But yeah, I don't know. Do you have any, you just like whatever? Do you care about debt? Do you think about it?
Can you give me like an actual example with numbers? Because I guess I think I understand the lever.
So let's say you've got, I'm going to make up some numbers here. Let's say you got $100,000. Burning a hole in your pocket, you're ready to buy. You could go do 100% of it on a property. Buy 100,000. We're going to go crazy, simple numbers here. Got a $100,000 property with your 100,000. Again, I know there's simplifications, whatever.
Sure.
No big deal. And let's just say that is $1,000 a month cash flow, but it's free and clear. So you're good.
Yeah. You're making money.
Making $1,000. Cool. But let's say instead you're like, nope, I'm only going to do 20% down. And so you buy 5 properties now.
Oh, because you put 20,000 on each one.
Correct.
Okay.
So you can kind of see where this gets interesting. Where
But now you owe.
And maybe let's just go with a hypothetical because of all the ratios, you still make $1,000 a month.
Okay.
Just for the funds of it.
Sure. For easy math.
Now, now you could make the argument that because if the interest rate's lower than what the returns can be on the property, it might actually be like slightly higher. But let's just, for the fun of it, say it's the same. Now you just go, okay, let's talk about market appreciation. And let's just say each property goes up by, 10% over some number of years, right? In that first scenario, you now have a property that's worth $110,000. But for the other ones are now worth $550,000. Right. And your mortgage has been slightly paid down. And so your equity is significantly, just right in there, ignoring the leverage part of it, your equity is now 5 times as big, which is great. But let's say in one situation, you have a tenant who moves out and you can't, whatever, they do a lot of damage and you got to fix it up. For the one that you're cash only, like that's a bummer. You lose out on the $1,000 a month rent. Bummer, but like that's all you're out. But let's say in this other one, if you have a tenant issue, like your mortgage still keeps coming and you're out that $1,000 minus the mortgage amount. And so you're actually pulling from all your other ones to make it work. Like that's where leverage can be awesome on the upside. Or what if the market falls, right? And it goes down 10%.
Yeah.
For the one, you're like, okay, whatever, who cares? But for the other one, like, man, you lost a lot. So that's that's where leverage, it's a dual-edged sword.
Interesting. So it allows you to get more, but there's more risk.
Correct.
Yeah.
Yeah.
Makes sense.
He also recommends having flexibility in planning. Maintain a hold period flexibility.
What does that mean?
Yeah. So when you own the property, it's called the hold period.
Like the amount of time that you have it? Okay.
Yeah. Which oftentimes, if it is like a buy and hold type of situation, you're like, yeah, whatever.
Could be 20 years or whatever.
Yeah. There's no difference between like 5 years, 7 years, or even potentially 20 years. You have that flexibility. Flips, there's a lot less flexibility. So it's, from what I'm guessing, he would be a lot less interested in that. Where if like when we underwrite a deal, is actually something we've been we're getting better at. Is instead of if we think a project is going to take 6 months to do, we actually underwrite it as if it's a year. Oh yeah, just in case. So
it's better to finish early than.
And if it doesn't make sense to hold on to it for a year, even though the plan is like we think we'll get it done in 6 months. Yeah, like you could run into a problem if you price everything out. So like, okay, we make money at 6 months, but when we get to 8 months, we're not making money. Like that's where you can suddenly get into trouble, I guess. So yeah, that's what it means by maintaining. Have enough margin built into the system where it's like, hey, if I got to hold on this longer, it's okay.
It's okay. Yeah.
Yeah. Again, that's the hard part about a flip is every single month you just lose money, right? Because it's empty. Whereas if it's like a buy and hold type of thing, you at least are getting the rent and it hurts a lot less. He also talks about capital alignment. You want to match the capital with the intended business plan. So again, if you're doing a flip, you're willing to pay more for your money because you're not going to hold on to it for a long time, and you're not going to make any payments for a while, or you're not going to. You don't want to. If you're doing a flip, you don't want to have to make payments to your investors during that hold period time. Our dog is the biggest troublemaker ever. That's okay. But if you have, if you had like a rental, so if you're doing a flip, you don't necessarily want to make payments to your investors because like that money's got to come from somewhere and it's not going to come from the property.
Yeah.
So that's what he means. Whereas like if it's a long-term hold, you don't necessarily want to have no payments and it's just like this thing that's ballooning over time. So you just want to make sure that it aligns with your capital aligns with the business plan.
That makes sense.
And then number 4, he talks about yield requirements. So I thought this was interesting. The stabilized yield should be at least 150 basis points spread to market cap rates. Okay. Yeah, I know. You got that one right.
That's way, dude.
What was the
numbery for me?
We're like, so I know all those words are English.
Yeah.
But
You just said a bunch of English words, but I don't understand.
yeah. So the yield is it's a fancy way of saying what's the return on the investment. Okay. And what he's saying when he say 150 basis points, it's the same as saying 1.5%. So
Okay.
if you buy a property, let's say the cap rate is 5% when you buy it. When you do all the fixes and everything else, when you go back and recalculate that cap rate, I want it to be like, so what did I say, 5%? You want it to be the equivalent of like a 6.5%, essentially, because the cash flow is increased by that much.
Okay.
That's what he's saying.
Cool.
It's just a way of measuring how much upside opportunity, like what's his minimum bar for upside opportunity. I don't know. I'm sure I could
Yeah.
probably play
It
with a
seems like there's
spreadsheet.
easier ways to measure that.
It's not a
maybe,
horrible one, but yeah, it's not. I don't hate it. I've never really thought about it that way, but
Yeah.
I don't hate the idea. Okay, now he talks about investment philosophy.
Yay.
We're rocking and rolling here. Location and growth. Buy in good to great locations and markets with job, population, and wage growth. 100%, no problems with that.
It's kind of
I agree.
intuitive. Like,
Well, yes.
although I suppose if you were attracted like, oh, these properties are super cheap, like we get so many
Right.
of them, but then it's like, yeah, but everybody's moving out of the area and there's
Yep.
no demand. Like,
Yeah, it's another way of specifying that supply and demand
Yeah.
part. Yeah, specifically for those pieces of it.
sure.
Risk management, avoid big mistakes, survive, and let time and compounding do its thing, which I think comes back to that quote at the very beginning part. It's like, yeah, don't do super speculative, dangerous things. Just like do the easy ones that you know you can do, and then just give it time.
Yeah.
And you'll win. It's all good.
Makes sense.
And then market intelligence, understand capital flows and how multifamily investing compares to alternative investment options. So I don't 100% know what he's saying here. Outside of if you're going to invest in this area, like you should understand how the investments work.
Sure.
I think it's what he's going on. Don't just blindly jump in. Like understand it. Like listen to this podcast. Awesome. You're doing great. And related to that, he says, be an expert in your space. So in my case, if you're going to invest passively with us, you don't necessarily have to be an expert. Outside of you need to be expert enough to understand recognize
how
what
you're
the deal is.
communicating the information.
And if you're hiring us for property management, you definitely do not need to be an expert in tenant landlord law, but you need to understand like how to be a good owner, I guess. And then he also says, buy deals with a strong product market fit, which we talked about this a very long time ago. I was looking at a property that was in another market altogether, another state even. And it seemed to me all the properties were all mid to lower end types of properties. And they were talking about fixing up this property to make it the high end property.
Okay. I
this area.
remember you
And
saying
I was
that.
like,
yeah. Like, why would you do that?
okay,
Yeah.
like, I get it. But it doesn't seem to fit the market and what people are looking for in this area. Maybe it's okay, which ultimately that deal actually totally fell through and they never did it. I was like, yeah, that's fine. Things happen.
Yeah.
But honestly, that's what you want, right? No capital was risked for it.
They just didn't.
They didn't buy
They
it.
didn't buy it.
Correct.
Got it.
Yeah. Our dog's the troublemaker. All right, final considerations. Okay, tax strategy. Don't let the tax benefits wag the tail. I will see stuff like that all the time. Check this out. This, for those of you on video, this is our dog's toy. It's a milk carton that he's super pumped about.
It's very loud. It's just a very
Also very loud,
toy.
which he decided to play with at 5 a.m. this morning. Crazy dog.
all done.
Anyways, your tax strategy. Don't let the tax benefits wag the dog. Okay. He's going to jump up and that is all going to fall over. Essentially saying, just like, yes, you want to optimize your taxes, but don't necessarily do things just for the tax strategy and benefit itself. That's what he's trying to say there, which I actually agree with.
Sure.
And again, market understanding, know why people live there. It may just be that it's price, and that's okay. But you want to know why. And that comes back to that article where he was like, why are people moving here?
Yeah.
Like, yeah, you got to know. You got to be like, yeah, dude, it's going to be jobs, it's going to be family, it's going to be weather.
Sure.
Yeah, and price is also going to play into it.
Is that just so you can make sure that the reason why they're coming is like you can provide those types of things, or like some of those things you don't have control
over? If the trend
over.
changes, you can measure those are leading indicators.
Oh.
And so if like a big employer leaves or talks about leaving, you go, oh, people are moving here for this job. That reason's disappearing. This trend's going to change. Or, hey, if people are coming here for work and there's a lot of diversity, cool, whatever. Mm-hmm. Yeah. And then finally, he says relationship focus. People want to do business with people they like. Relationships first, deals later. Which I think is a good lesson.
Yeah.
So those are his 19 core principles. I think I agree with all of them.
Yeah.
To the extent
They
that I
seem
understand
solid.
what he's going for. Wow. So that's what we got. Thanks for listening, and hopefully those made sense. I'd be interested to know if you agreed with those principles or not. And if you are interested in investing with us, you can also check us out at furlo.com. You can learn more about our investment thesis and a lot of our core investment things. So with that, thanks for listening. Have a great day.